Good morning, everybody, and welcome to this morning's EMIC Academy. I hope everybody on our session today is not too windswept. For those who don't recognise my voice, I'm Patrick Smith and I'm the principal of the EMIC Academy. And our session today, Trade Credit Insurance, Lessons Learned from the Global COVID Crisis, and I guess we continue to learn lessons because it's still going on, will be presented by our valued partner, Chubb. Now, over and above their formidable property and casualty credentials, Chubb has been a leading carrier of trade credit insurance for many years, providing broad cover and advice and backed by Chubb's global reach, underpinned by in-house country risk analysts and strong financial ratings. So the Chubb Trade Credit Solution supports business in securing finance, managing bad debt provisions whilst facilitating growth, and further trade credit insurance from Chubb is a core component of their clients' corporate governance. So trade credit has always been a device for companies to manage cash flow and an instrument often bled into supplier and partner agreements. So this session, it will be very interesting to learn whether trade credit arrangements will increase as a result of COVID, whether the risk of default will increase as a result of the pandemic, what the implications are to businesses with trade credit exposures, and of course, what the impact will be on insurance availability, terms and costs. So it seems to me trade credit always sounds a bit niche, but it's a massive risk area for us to think about. So in this session, we'll receive insights into the impact of COVID on trade credit and on supply chains, what COVID has exposed compared to the other recent financial crises. We're going to have three things that risk managers should be aware of when considering their trade credit arrangements, which is great, and how the financial and legislative interventions have disrupted trade credit claims. And there'll be a theme of interwoven case studies through this morning's session, which I think brings the theory to life. So looking forward to that. Just in terms of logistics, I'll introduce our presenters in just 1 minute. We're running to 11 o'clock, so we'll have the formal presentation. You may have questions occurring to you throughout the course. Now, if you do, if you look at your GoToWebinar control panel, you'll see a drop down that says questions. If you pose your questions there, when we hand over to the Q&A segment, which will be around and about 11:15, I on your behalf will manage those questions so everything on the table can be answered. As you leave, finally, once we're done, there will be a survey, and just as a heads up, it would be great if you could complete the survey. It's very useful to our presenters to know how they've done, and exceedingly useful to EMIC in understanding the value and potentially future opportunities for sessions going forward. So with that, let me just introduce our speakers today. So firstly, we have Babak. And Babak heads up Chubb's Global Markets EMEA Country and Credit Risk Management team in London. Before he joined, or I should say rejoined Chubb in August 2018, he worked at various London-based investment banks and insurance companies, covering credit and political risks in EMEA and East Asia. And he studied in Germany, Shanghai and London, and has been a CFA charter holder since 2015. So we've got some really deep but broad global experience in the house today. And he's joined by Andrew, and Andrew has headed up the claims function for Chubb's political risk, credit and surety offerings since 2018, having previously held similar roles in the London market. Now, he's a qualified solicitor who, prior to joining the insurance market, worked in private practice, specialising in international arbitration and complex insurance disputes. So it's great to have sessions with lawyers involved. Let me tell you, claims, that's where the rubber hits the road. So Andrew, very welcome. And let me hand over to you and let's get started. Over to you, Andrew.
Thanks very much for that, Patrick, and welcome everyone. Thanks for joining. I'd like to start by giving an overview of what I'll be discussing. I'll be rattling through this quite quickly because of time constraints, but of course at the end, questions are very welcome. So what we'll be discussing initially are the themes and trends we've started to see evolving from the COVID pandemic and how that's impacted on our claims experience. And then, as Patrick stated, to bring things to life in what's probably the most effective way, I'd like to run you through 4 case studies. So to begin with our themes and our trends. The first thing I'd like to communicate is that the impact of COVID on our claims portfolio has been delayed. This is due to both natural and man-made reasons. In the natural sense, claims always sees a delay. You have, in the credit world, the non-payment, the default on the obligation. Then on our policies, you have a waiting period. Then you would have your claim. So there's naturally some time. But what we've seen happen here is man-made government financial intervention, which has propped up otherwise failing transactions. This has happened on a global level. We've seen government support in many different ways, but it's been almost universal. Once this support starts or has started to ease off, that's when you see the claims start to manifest, when weak obligors can no longer support their obligations. And we anticipate that that will increase as time goes on. From a European and more close to home, a UK level, we have seen government-backed schemes for trade credit where they will underwrite exposures. This has proven moderately popular in the market, but not every insurer has opted for it. Chubb have not for our own reasons. It just didn't quite match our appetite, but it's being offered, and you're seeing that replicated across European governments. On the legislative side, we have seen some, in my view, hasty legislation in the form of the Corporate Insolvency and Government Act, which came into force a couple of weeks ago and makes it much, much more difficult than previously for failing companies to be put into administration or liquidation. The aim of that is that the government's view is if they don't make a failing company the taxpayer's problem, that is a good thing. The downside is the almost universal law of unintended consequences. The legislation has been drafted in such a broad format that it is inevitably going to create situations that the government didn't intend. One quick example is that the legislation expands the remit of essential supply. What that means is that if you have a company who has a contract with another company to supply goods or services, and company A is no longer financially able to provide the money for those goods or services, company B legally cannot stop supplying. They have to keep supplying to a company that can no longer pay for those goods or services, because the government is determined that company A stays afloat. I can only imagine the impact of that going forward, and it makes for a very difficult conversation on an insurance level where we would otherwise cover those supply obligations, but we have exclusions that say if you have reason to believe a company is or will become insolvent or will not be able to pay, you should cease your supply. That's just one example of where this legislation and this intervention may lead us. In terms of the impact I anticipate seeing going forward in how we look at business, less liquidity will lead to more scrutiny and more onerous due diligence procedures. People across the spectrum will have to be much more careful that those they are entering into business with or writing risks in respect of have the capacity to fulfill those obligations. And that will require a really good look in very uncertain economic climates. The other aspect that we're seeing is that businesses which were previously weak are now in a much, much more difficult situation. If times were bad for you when liquidity was high, you will now face tremendous stress when there are liquidity crunches all around. Turning to some more themes that we are seeing, it's likely there's going to be greater political and civil unrest with less money floating around. It's likely that this will be long tail, what we're seeing. I certainly don't anticipate that we've seen everything there is to see coming from COVID. It's going to take at least another year for the claims picture to be clear, and perhaps 2 years. This is all because of the runoff of the intervention. It's because people are doing their best to prop themselves up. It will take time for all of the dominoes to fall. As mentioned, we expect to see greater scrutiny of lending practices and structures, and you'll see why when I discuss some of the case studies. We've already seen some insurers pulling out of the market due to what we're already seeing in claim scenarios. There have to date been some high value claims, and for some of our colleagues in the market, that's enough to take your marbles and go home, because quite realistically, as I've mentioned, we have not seen the bottom of it. And some insurers simply say, well, if it's going to be like this for another year or another 2 years, it's more than we can financially justify. We also have noticed that certain lenders who we work with are closing their trade commodity and supply finance units, because again, based on what's happened to date, it does not appear that some of these models are sustainable. So those takeaways that I really want to impart on you is we have not yet seen the full impact due to both the natural function of the market and the targeted intervention. Some of that intervention will likely create more harm than good, because when you make policy in a hurry and in a foxhole, it rarely makes for good law. And the aim of the UK government at this stage is to keep companies afloat by any means necessary. And that is not always a good thing. And that can have far-reaching consequences, which are likely to play out over the next year or 2 years, as are the claim scenarios. The impact of that is much more scrutiny across the board. Insurers, people like Babak, will be looking much more closely at the structures, at the ratings, at the financial underpinnings of those organizations we are doing business in respect of. Lenders will be looking more carefully. The market will be likely to harden, because we've all realized these things can happen, are happening, and need to be priced accordingly. And from claims perspectives, we'll be looking to learn all the lessons we can. We always adjust things in the same way, but we will be keeping a close eye as to what is developing, what things are we seeing, what can we take from what we see to best advise our stakeholders going forward. And now to get to the meat of it, let's start discussing our case studies. So this is one which is unfortunately becoming a recurring theme. This is an instance where COVID didn't cause the issue, fraud did. But COVID meant that there was nowhere left to hide the fraud. There was no new money to cover the problems. So we have a Singaporean oil trader and bunkering company. In April this year, the company collapsed into insolvency after its founder admitted that he had concealed $800 million of losses over the previous 4 years. Again, it didn't happen instantly, it didn't happen now, it had been long term, but it came to light now. It's a huge exposure in the market, upwards of 4 billion to the lending market, and the insurance market has claims exceeding 100 million. The conduct had been long-standing, where they've been receiving funds, they've been putting it on other accounts, they've been robbing Peter to pay Paul, essentially, selling cargo, buying that cargo back at a lower price while overstating their balances. This had all been leading up to a crunch point, but it's very likely that crunch point could have happened years before. But then came the COVID impact. And so what we saw then, moving on to talk about that, is that while the fraud happened beforehand, COVID was the trigger for the fraud coming to light. This particular obligor made their living based on an oil price. They bought oil at a certain price, sold it after mixing and blending it at a markup. They bunkered oil and received money for that, and they borrowed based on the value of the oil that they held. COVID led to a transportation shutdown. Transportation shutdown and the credit crunch led to a crash in oil prices. The crash in oil prices led to the lending banks looking more closely at their books and saying to this particular trader, given that we have loaned you X on the basis of you holding Y assets in oil, those assets are now worth less. We will make a margin call. Can you please give us the difference in value in cash between the oil you hold and the money we've loaned you? That money did not exist. It had ceased existing years beforehand. The business was weak. This made it untenable. It then collapsed because the markers have been called in. It's a story we are seeing repeated. But to give you a different example in the second case study, what we are seeing here is trouble precipitating in the retail sector. It's happening in the UK, but the US has seen the more immediate impact. Remember what I mentioned about government propping up companies, especially in the UK. It's taking longer here. But in the UK, we've got multi-buyer policies that we provide to various insurers in the US. One of these, our insurer provides onwards credit to large US retail outlets. You would know all the names if I mentioned any of them. Of that portfolio, since May, 4 have entered Chapter 11 bankruptcy proceedings. These are 4 major US retailers that have been around as long as you can think of, have suddenly gone into Chapter 11 in a domino effect, one after the other. The indebtedness exceeds at the moment 6.5 million. It could go higher. These are 4 that have gone. There are 4 more who are reporting that they feel they cannot keep trading for much longer. Potential additional losses in relation to these are 4 million and again may go up. Now, how did COVID impact on this? If we move to think about this, the sector was struggling before COVID. Babak has given us many internal presentations over the last year about how footfall has been decreasing. Things were not good, but they were livable. Then here came COVID. What happened to the retail sector with COVID is that online sales surged, high street sales disappeared completely. For these retailers, they had huge footfall, but poor online presence. We sometimes make the assumption that everyone has a huge online offering. That is not the case. If you want an easy UK example, think of Primark. Huge amounts of business, people storming into the stores. I can attest they make great boxer shorts at affordable prices. But online, nothing. When COVID hit in the UK, Primark fell into a hole. This was more widespread in the US. Lockdown, post-lockdown restrictions means no one goes into the stores. If no one goes into the stores, you can't pay rent for those stores. You're not generating an income from those stores. If you're not paying rent and you're not generating an income, you cannot obtain lines of credit. You can't get credit, you can't keep paying wages, you can't keep paying those rents. You have warehouses full of stocks that can't be sold. And inevitably, you cannot fulfill your obligations to your creditors. And therefore, where we cover those obligations, we see claims. Moving on to a similar but slightly more nuanced example. In Chinese textiles, one of our insureds provides credit to an enormous Chinese textile manufacturer, one of the largest textile manufacturers in the world. They started experiencing financial difficulties with their debt in 2019. They'd had a very acquisitive run. They had bought a lot of brands for multi-billion-dollar prices. They were looking to grow, which is great and is fine when people are buying your product. Their debt exceeded 5.5 billion. Then COVID came along, and this was the impact. While they were acquiring, they were able to borrow because people were buying and the economy was at a high. But they'd had financial difficulties. Those financial difficulties had seen multiple rating agency downgrades within a 12-month period. With COVID, that became almost terminal. They had had a lifeline in sight where a major stakeholder was going to give a major capital injection, which would have taken the majority of the debt load off of the table. Then with COVID, the stakeholder decided that they were actually going to cut their losses where they stood and were not going to inject more money in the company. A manageable situation became an untenable one. Those debts have no easily apparent way of resolving themselves. Now, like many companies across the globe, their only hope is in government intervention. Will local government, as how it works in China, who have a large stake in the company, pour more money in to keep their investment alive, or will they allow it to collapse? That is inherently uncertain. It means we are in an uncertain claims scenario where things will turn simply on government intervention. But recall what I started with the theme. Government intervention is not a panacea. The governments cannot prop failing companies up forever and may not have the appetite to do so. So when we look at things from risk perspective, from claims perspective, from probability perspective, with scenarios like these, I view them only as buying time. And again, think about the timeline of a year to 2 years to see how things shake out. This company may get a cash injection today. That is putting a sticking plaster on what was an already pre-existing problem. In a year or 2 years, we'll really see if the company has long-term survival prospects. Otherwise, we are just buying ourselves time, and a claim that would have eventuated in Q4 2020 may instead appear in Q3 2021. Moving on to the final case study example. Again, something completely different, but to give you the spread of what we're seeing, this is a matter that has been ongoing since perhaps 2017 or 18, not a new matter. It's an Asia Pacific satellite program where a specific government was purchasing a satellite from our insured, and we were covering the risk of non-payment for this contract. The contract had already been in a bit of trouble in 2018, but all of the parties had put their heads together and they had brought in new funding options, and the insured felt that this contract, which is valued at $28 million, would be satisfied. But things then started to wobble come Q1 of this year. And what we had with COVID is suddenly the new investment, the new money that was going to work hand in hand with the government, said as of April and May, they are not sure that it's a good idea to put multi-million-pound investment into communication satellites when there is not a lot of liquidity around. The government, which is meant to be underpinning all of this, said they now have internal economic struggles. They have companies that they need to intervene with and prop up. They are no longer sure they can support the project. The funds that had been put aside have now been diverted. This specific project relates to an emerging economy. Money was already tight. People are clamoring to government to help. These things like communication satellites now seem like, if not vanity projects, certainly optional extras and are no longer priorities. Our insured is now running out of options because the government is saying, we are not sure we can fulfill our obligations because we have higher priorities. Investors are saying, we're not sure this is the best place for our investments given what's currently happening. This, again, is another story we are seeing play out. But if you want to draw a thread between all of these, look at all of these case studies and think, none of these came out of the clear blue sky. None of these came from nothing. There were inherent structural weaknesses in all of these economic scenarios before COVID. Things were already in a place where there was potential danger. COVID exacerbates existing danger. It creates a terminal situation for weakened companies, and it exposes fraud and weaknesses in scenarios where that exists. That is what we have been seeing. That is what we will be keeping an eye out going forward. And that is what we anticipate dealing with in the medium to long term on the claims perspective. And with that, with great pleasure, I'll hand you over to Babak to go into some more of the nitty-gritty.
Thanks, Andrew. Yes, hi, welcome everyone to my part, which is analyzing the impact of COVID on supply chains. And as Andrew alluded to, a lot of these trends I'm going to talk about were not created by COVID, but were either uncovered or accelerated. Let me just talk you through some general trends which pervade all of the sectors I'm going to talk about today. So what has happened at COVID has definitely, what we've seen before already, accelerated a trend away from these very thin, very stretched supply chains that have the advantage of reducing costs materially, but require absolutely open borders, frictionless trade, no interruptions at all, but they have come unstuck. The first sign was the US-China trade tensions that saw already some disruptions there. The tech war, I'm going to talk about a little bit later as well, have accelerated that trends with some, especially tech companies, moving out of China exclusively into surrounding countries. The trend keeps going. I have found a survey by McKinsey that I've interviewed managers before and after COVID. 70% of managers or risk managers of large US companies said they wanted to move towards resilience in their supply chains before the virus. By May this year, this number increased to 93%, because obviously everyone was impacted by it. Measures taken, starting with the more obvious, are nearshoring and reshoring. Nearshoring means you put your supply chains closer to your markets. In the US, there will be Mexico, of course. In Europe, there will be Eastern European countries. Reshoring is just bring it back home. This is a big trend in the US. The current president's a big fan of this idea, but it has happened in Germany. It started 10 years ago already, where the vulnerability to Chinese manufacturers for certain parts was deemed a risk German companies did not want to take over the long term and move towards Poland, Czech Republic, Slovenia, and Slovakia. The other idea is to create multi-source supply chains. It's called the so-called China +1 or China +2 or +3 in some cases initiative, which means you still rely for a big chunk of your inputs from China because the infrastructure is there, the skill set is there, the factories are there. These can be multi-billion-dollar component factories. You can't just uproot them in China and put them in Coventry. This is very difficult to do that. But then you move from China to Vietnam, Bangladesh, Thailand, just to thin out a little bit. Apple did that after the Fukushima disaster, where they saw some inputs from Japan that impacted. Toyota, the same thing. Again, as Andrew said, is not a new trend, it's accelerated by COVID. Other measures are reducing unique inputs and increase inventories, build up stocks, move away from these just in case, just in time, towards, so move away from just in time to just in case, build up stockpiles for critical inputs, and of course, improve risk management procedures. The My favorite example here was, again, another thing done by a US company before COVID. That was a small company called Biogen that produce pharmaceuticals and antibiotics, etc., for the American market. And a key part of their bags where they sell these products in are done in Puerto Rico. But they have got a very sensitive risk management process in place. Weeks or months before the last hurricane struck, or the earthquake actually struck, the hurricane struck, they saw weather patterns and analyzed them and deduced that this is quite likely to hit Puerto Rico. So they started weeks earlier to move production of those plastic bags. You can move those away. You can build up different supply chains from Puerto Rico to the US, and the impact was a shutdown of a week or maybe two rather than months from their competitors. You can see that you don't have to uproot production. You can just improve your risk management procedures. Governments, especially in the US, will help you, or will help many of the companies to reshore manufacturing centers, especially in sensitive sectors. Electronics, we see this in US a lot, and of course pharmaceuticals that are overly reliant on inputs from China. As a credit risk analyst, I think this is going to be on balance credit positive for firms because it strengthens supplies. Yes, costs will go up, absolutely, margins will go down. It will have an initial impact on cash and capex, but given that many of our policies are multi-year policies, this is overall a good thing because as this crisis has shown, a company can only be as strong as the supply chains. And as Andrew said, pandemic also exposed a lot of fraud cases, and there are, I believe, more to come. This is not a usual trend just for the pandemic. This happened before. End of cycle tends to uncover fraud because, as Andrew said, money becomes tight, scrutiny becomes tighter, and then you can't sort of keep doing as I've been doing before. Of course, the impact of COVID is completely different for each industry. I have tried to simplify as much as I could to higher and lower impact. It's quite self-explaining. I'm not going to go through each of those points, but clearly the higher the trade intensity, which means you source inputs from various countries via various suppliers, via various supply chains, and you depend on sort of choke points in Asia, in Eastern Europe, then you are definitely impacted. Higher labor intensity, supplying Andrew's favorite shop, Primark, for instance, because it's apparel, of course, they will be impacted because you have a lot of people working in very close proximity to each other in a often humid and very dense environment, which means it's a pandemic, those are shut down first. It had massive impact on key supply chains in Bangladesh, for instance, where apparel production was shut down. Another critical point to look at is multi-tier supply chains. I'm going to talk about General Motors later. They have 18,000 suppliers in various countries. They supply to each other. So you're not only looking at the ones who supply General Motors, but also those who supply their suppliers and down the cascade. We have found that electronics, telecoms, apparel, excuse my pronunciation, and industrials are more impacted than food and beverage, fabricated metals, and medical devices. They tend to have lower trade intensity. They tend to be produced more in the countries. Goods are storable, and they're often critical sectors in which countries prefer to have a sense of self-sufficiency as much as they can. But now let me talk through IT and consumer electronics. So we have seen a big impact. These are quite at risk of impact from some disruptions and open borders and pandemic shutdowns because they have very, very thin supply chains. They tend to produce in the East, sell to the West, and any bottleneck in the middle of that can have a massive impact because a lot of these companies, I'm going to talk about Dell in a minute, have very low storage because they produce just-in-time products. You order them, they manufacture, and they get delivered to you. They have very, very low inventory. But it turned out that once the sort of the wave in China stopped and production resumed months before here in the West, the impact still didn't go away. And it turned out that banks, risk managers like myself, have noted that it was confirmed to us that IT supply chains were not as much impacted by COVID over the longer term than by the actual US-China tech war. We can see that in the disruption between Huawei. This has been going on for years. It was not created by COVID. Arguably, COVID has no impact on that. It won't even accelerate that. This is a much bigger trend, and has been leading to decoupling of those two economies as much as they can. But I'm going to show in the next slide, it's not that easily done. There will be increasing government support, especially in the US and Europe, to support reshoring chip manufacturing. I mean, there was this plan between American and European governments to fund billions of dollars towards Nokia, Ericsson, etc., and some American companies to create 5G, which with Huawei is a key supplier at the moment. This isn't done easily. This will take years. There's a regulatory problem because of the European concerns about supporting companies, and bailing them out is quite difficult to do here. But this is only going to be increased by the COVID-19 crisis. But yeah, as I said earlier, this trend towards strengthening supply chains will be very difficult for companies like Dell, whose entire business model is focused on having low inventory and very low supply chain costs, but delivering your product to you without storage. You order something, it's manufactured, put together, and sent to you. Nothing is stored. So if people don't order anything, there's no inventory. And if there's suddenly everyone starts to order, but there are still supply chain issues in China, you can't produce, that is a trouble. That is a problem for you. Let me move on to the next slide. I've mentioned it. I mean, this shows, I don't have to spend much time on this. It's quite clear that even if you move to China +1, +2, +X, you cannot get out of China because they produce the vast majority of electronics and also components. So if your computer is made in Germany or US, it will contain a lot of Chinese input. But let me move on to industrials and say a few words on that. These supply chains tend to be among the most complex ones, relying on a whole cascade of tier 1 and tier 2 suppliers. Tier 1, briefly, original equipment manufacturers, Rolls-Royce providing engines to planes and Goodyear tires to all the big car manufacturers. And tier 2 suppliers then supply tier 1 with rubber, with smaller parts, with metals, with in commodities. I've mentioned GM earlier. They have 18,000 suppliers. It's almost impossible to make that supply chain resilient within months. It's very, very difficult to do that because, as Andrew said, unfortunately, a lot of them might go bust. Then you have to find new ones, create new ones, support them. But yeah, this will take some time. And the COVID-19 crisis disrupted this cascade at various points. Let's say health-based lockdowns in Europe and America. For American companies in Europe, it was northern Italy. In Mexico, for American companies, it was in Mexico. But it showed that it doesn't have to be just that, because I put in 3 examples here. Volvo, for instance, Sweden, as we all know, had no lockdown at all. But Volvo still was severely impacted because their supplies are not necessarily in Sweden. And they also imply not only on supply, but also on ships moving across, on ports. Even they were heavily impacted. General Motors, as said, 18,000 suppliers. Airbus has 12,000 suppliers. Dell, 4,700. Lenovo has 4,000 suppliers. It's almost impossible to protect all of them. But within industrials, there are some that are more and some others that are less vulnerable. Pharmaceuticals supply chain tend to be more diversified because they have to have a very robust supply of active pharmaceutical ingredients. Although China produces a vast majority of inputs like antibiotics, vitamins, ibuprofen, all that stuff, a lot of the very large firms have the capacity to produce them in-house. They can do it. They've got the networks, they've got the intelligence, they've got the skill set, they've got the factories, they've got infrastructure, everything's in place. But the problem is this, of course, raises prices a lot. And pharmaceuticals also have political pressures. I mean, in the US elections, as we can see now, pharma prices are mentioned now and then. They're part of the program of both parties to get them lower. It's very difficult for pharmaceutical companies to raise prices, especially now when there's election coming. No one is going to support that. There is some appetite, of course, now, but this COVID crisis will at some point be over, and then but prices will still be higher. And then how can you lower them down again? Are you going to move back to China? It's very difficult to manage. Let me talk about commodity traders, which is a very interesting topic that Andrew, of course, was talking about, because there we saw a big impact. All of them were pre-COVID. None of those issues we had seen in commodity traders were impacted by COVID itself, because most commodity traders, especially if you're well managed, they hedge your prices. They have policies in place to make sure that price volatility, they actually benefit from it. And we saw some of the big traders in the news, the very big ones, Trafigura, Vitol, Glencore, actually made good money out of the oil price collapse, because that's what they do. They get the spread between the price they buy this oil and the seller oil at different points. But a lot of them failed to repay their bank lines because they are secured over oil price, had a wrong hedging policy. They didn't match those prices closely enough, and that was a big trouble, leading to a lot of companies defaulting. Those defaults led to some big names exiting, especially Singapore, where we saw a lot of fraud and a lot of issues there. ABN AMRO, big names, SocGen, BNPP are moving some finance out of Singapore into Hong Kong. But I skipped the middle bullet point, but I'm going to go back to it in a second. The problem with that reduced finance is that banks' attention to their existing clients has sharpened like a sword. And this has led to big names, Hin Leong, Hontop, failing since the COVID-19 crisis, because trading losses have been covered up, secured inventory had been overpledged. There was an issue going on for years before, but it works like a bit like a Ponzi scheme. As long as you can get more finance in, you can pay the others out, and it's fine. No one asks any questions because everyone gets repaid, everyone gets their oil. But as soon as there's one issue there, someone asks some uncomfortable questions, some banks exit the market, this whole Ponzi scheme comes unstuck. And I'm afraid we might see more of that. We did see some of that way before COVID. Noble Energies, Noble Group, was a big name, of course. That was triggered by a whistleblower, granted, but if it had been a whistleblower, COVID would have uncovered that one as well. And presumably also the end of a cycle, because most economists had been expecting a recession regardless of COVID. Presentations have been galore since mid last year. People expecting, when is it going to come, the recession? And COVID-19, well, be careful what you wish for. Gave us the worst one in 130 years. The problem with that in Singapore is that there are a lot of well-run traders. They're mid-sized companies, they're well-run, they have good processes in place, they have no fraud issues, but they will struggle to access finance. So what we are seeing is these bad eggs, large bad eggs, will probably push some very well-run mid-sized energy traders out of business, which is very unfortunate because it's no fault to their own. But again, let me just end this slide that COVID-19 seems to have accelerated the trend rather than created one. Here again, let me just I'm conscious of time. I'm gonna more or less rush through this one because I want to talk about lessons more than this. Other impact was protein production was severely impacted. It's very difficult to social distance when you're sort of cutting up meat. Factory shutdowns in the US, where in the US and in Germany, Tony's for the big example, resulting in a local lockdown, resulted in a lot of companies and shops in Germany not being supplied with meat. And although governments, especially in the US, ordered staff to go back to work, they didn't. And who can blame them if you wouldn't want to go back to like an unsafe environment? One, I would like to talk about size matters because it leads to my next slide. Because if you're a big company, you can afford to work around that. Samsung, for instance, they flew out important part for their phones from Vietnam directly to the Chinese factories, circumventing the issues at ports where they don't have the capacity to actually process cargo because people didn't want to go back to work because there were increased health and safety issues. Samsung could get around it, many others could not. Commodities as well. People think commodities can be stored indefinitely. They can't. Some can, crude and coal can. To some extent, if the vessel is fine. I mean, we see in Mauritius a couple of weeks ago, they do break down, and the longer they are unprocessed and sort of bubbling around in a dense port, the higher the risk of something going wrong. But even if nothing goes wrong, some energy inputs go off, especially LNG. There's no need for me to highlight the stresses of perishable goods. I mean, if you have got loads of tomatoes on a boat, you can write them off. But let me just go to the next slide, which talks about lessons learned. What lessons have I learned as a credit analyst? Clearly focus on resilience. That's the thing. There's no point saying, oh, we can do this company because I believe oil prices will be 10 to 30 or $40, because in fact they were negative at some point. Who would have thought about that? You need to make sure that your balance sheet can sustain a shock. How do you survive a shock? With cash. Make sure the company has got lots of cash, either on a balance sheet or they've got committed credit lines that can draw down quickly, which they have, to make sure they can survive this crisis for 12 or 18 months. Because as Andrew said, I fully agree with him that when he said that the crisis has not even started yet to feed through our books. This will last well to next year. I mean, for example, in Germany, the companies can't even declare bankruptcy yet. This is a government measure. This might be pushed into next year, and once this restriction is lifted, floodgates may open. Working capital management, very important. How do you manage your current assets? Do you have access to credit to support those working capital quickly? I.e., can you go running? Can you keep running despite banks shutting down for now, or the economy shutting down, people are going to work? Can you do that? And cost analysis. The lower the fixed cost, low vulnerability. If nothing happens and you can send everybody home, your factory is shut down, you don't have running costs, you don't need energy, you don't need fuel, you don't need to pay whatever other fees there is, that's fine. You can just shut down, put a big lock on the door, go home, and come back in a few months' time, open up again. Hopefully everything is in place. And most importantly, in a crisis, a company is only as strong as its supply chains. You can be, Volvo had no lockdown at home. Swedish market actually did better than most in Europe. Still, sales down because they couldn't get the access to their own components from abroad. Before COVID, size matters, of course, yes, but some very well-run, smaller, mid-sized companies are, of course, very, very interesting too, if they are done properly, if they run properly, if they are have a niche in their field. But this crisis definitely showed that bigger you are, the more likely you are to survive this. I mean, for instance, pharmaceuticals, they can produce pharmaceutical ingredients in-house. Samsung, they can fly in products. Boeing, that can supply, even they had their crisis before, for the crashes, Rolls-Royce problems, but they could access government finance that they use to keep their own suppliers afloat. That is really important, because they know once everything resumes, we need to be able to ship out planes, to keep running. For that, we need to have our critical suppliers also alive. If you're big, you can do that. Know your customer, due diligence, very, very critical, as pandemic and end of cycle tends to involve a lot of fraud. We saw it across sectors, NMC in UAE, Wirecard in my home country, Hin Leong in Singapore. All of them had issues far predating COVID, but COVID uncovered that. All of them had access to vast funds, billions of dollars from different banks. But again, if more money comes in at these low rates, no one asks any question, because you get repaid. That disrupts, people ask questions. It turns out the owners defrauded the companies. It's very difficult for us in insurance to find that, because we really rely on our insureds, our banks, to do the correct due diligence. And I mean, I didn't put it in here, but the reliance we can put on auditors obviously has also diminished, because all of those accounts were audited, especially Wirecard and NMC for years, by all the big names. They didn't find it. They said, oh, I've got $2 billion in a bank in Thailand. Oh, okay, fine, signed off, next. You can't just do that. You actually have to, they didn't go to the Thai banks and actually ask for a bank statement, which should be accounting 101 really. But you have to be really careful with that. And how do we do that? It's difficult to answer. I suppose one is, if it's a company owned by one or two individuals, some alarm flags should be raised. If it's a transparently run firm, the chances are there's more board oversight, there's more regulatory oversight. But again, you don't know. The next risk management procedures for booking centers is quite critical for traders. If you have several booking centers, one in Geneva, one in Singapore, one in London, for instance, that is quite good, because it means there is probably a central board that actually monitors all the flows. If you have dozens of booking centers all across the world, in each country, for instance, that is ripe for fraud, because then you can double pledge commodities, double pledge cargo without headquarters in Geneva necessarily noticing it. Finally, because we can't often do as insurance company due diligence ourselves, we can't just fly out to Singapore and look at all the books and accounts. Our relationship to the insured is critical. We're going to continue to support our key clients, of course we are, but we have to rely on them a lot more than we normally do to do the right thing. And with that, I'm going to open the panel for questions.
Superb. Thank you very much indeed, Andrew and Barak. I mean, a fascinating walk through the current trade credit risks and how that's morphed through the COVID experience. A few questions arise, and I really want to focus on implications to insurance, I think. And the first is, with the enhanced lender criteria that you're anticipating as a result of what's been exposed by COVID, and the recommendation that policyholders should really tighten up their due diligence with their partners and tighter processes, do you ultimately think that in the medium term, trade credit risk and its insurability will actually improve as a result of the cycle we're going through? What do you think, Andrew?
I think it's likely once we come out of this, yes, everyone will look at things much more closely. The quality of the risks will be higher, and the types of risk written will be better, in my view, because of the lessons that everyone has learned throughout this.
Yeah, and I guess what we're sensing is to get to that more beneficial point, it will mean that weaker companies, notwithstanding the legislation, may fall away, but it's going to be pretty horrible in insurance terms until we get to that point, as we go through this kind of melee of claim activity, you know, corporate failures and the disruptions. Just one thought around the insurance, and you may have a view as to whether captives are used widely for trade credit risks, but do you see this as an opportunity for captives? Babak, maybe take that one.
It's difficult to say, because maybe once we're out of this, as Andrew said, yes, maybe. For the moment, I would be probably quite careful to talk about opportunities just yet. Don't forget, I'm a risk manager. I'm focusing now to make sure that our book is resilient for the big onslaught of risk happening this year, next year. And I think I might be talking about opportunities once that part has vanished from my desk.
Yeah, I think my take on it is that opportunity is maybe not the right word, but for those large organizations who have been used to purchase trade credit insurance at a certain price and price point, actually, if the capacity is reducing, as you mentioned, Andrew, and consequently price is increasing, it may be that retentions increase substantially. And ultimately, whilst it may not be an opportunity for captive, that may emerge as really a credible financial instrument to have to use to manage the trade credit risk. And a last question, I think, on the insurance side, should insurance buyers, who no doubt are in today's session, are we to expect very different insurance proposals and renewal requirements as your due diligence improves? Is that ease with which we can buy insurance or renew it? Is that going to change fundamentally? Who'd like to take that one?
That's probably one for Babak. He's the gatekeeper.
Right. Yeah. That's a very good question. I would say that I would definitely want to put a heavier focus on some due diligence, on some risk management questions. Yes. I don't think it's going to fundamentally change policies. I don't think so. But I do think that sort of the scrutiny we have to do now has clearly tightened. The lessons learned now we have to use, and we can't just ignore them now. It would be at our own peril. But again, I think it will tighten policies. It will make it a bit more difficult potentially for our clients to comply with our requirements. I do not think there's a fundamental change.
So I think the message for risk managers there is the better you know your risk, the easier it will be, and maybe start a bit earlier because there's likely to be some change in the processes and the requirements. And last question, given that the lenders and the banks are going to be increasingly focused on the underlying risks, do you think they're potential new insurance entrants? So bank assurance, if lenders know the risks so fundamentally well, do you think they may step into the shoes of some of the insurers who may retreat because of their claims exposures?
It would be a bold move at this stage. If so, it would really depend on whether they felt the worst was over. Because if something like this has further ramifications or could reoccur, then it might be imprudent for someone to enter the market without fully knowing exactly how to handle risk like this. I.e., there's usually a reason why people are exiting a certain market. So you'd have to be very bold or very knowledgeable to try and fill in that gap at this point in time.
Yeah, I suppose the degree of due diligence and risk knowledge really is the difference between the past and the future. But completely accepting the point that it's one thing to have a desire for more knowledge, the other thing is to actually have it. And as you've mentioned through the case studies, many of the organizations we're talking about, were potentially weak or had underlying flaws or lack of resilience in the first place. So brilliant. Thanks for addressing those questions. Let me just move on to some closing remarks, really, and just reflecting, I think, on what I've heard as a risk manager. I think it'll be really interesting to see what the impact on corporates of their financial strength. And what I mean by that is their rating or potential re-rating and the impact that will have on the availability of credit and lending. And that could fundamentally change the way in which companies have become very used to operating. I'll be very interested in the impact of the new legislation and, the benefit. I can see socially the benefit of trying to keep companies afloat, but actually, if they're dead, they should be allowed to die peacefully. And, I really, it resonated with me, the flags you were putting up there, Andrew, around that particular topic. For a risk manager, of course, and if we talk about the risk management done not only by EMIC members, but our finance colleagues, our commercial colleagues, our partnership colleagues, due diligence has never been more important. And, without wanting to turn this into a supply chain topic, clearly credit risk really is hand in hand with the quality and the shape of the supply chain. And I think what we heard, and really it's a heads up for risk managers, is many organizations will be really rethinking the way the supply chains work, the reliance on China, and ultimately the supply chain risk profile will therefore be changing. So it's a matter for risk managers to pay attention to how is that supply chain changing? What does the risk look like? And on a risk first, insurance second basis, I'm sure that organisations that know and understand their risk do better in the insurance transaction than those that don't. I think the COVID-driven new liquidity risks in corporates is clearly going to be an ongoing issue, and as we see kind of state and governmental support potentially coming and going, it's going to lead to uncertainty. But one thing's for sure, there'll be a pressure on margins, and in my experience, pressure on margins has always led to a complete focus on cash control, savings, and retaining cash for as long as possible. So I think a world in which lenders pay more attention to the risks that they take as they ramp up due diligence, KYC, ultimately it's a healthy, less risky outlook in the medium long term. In the short term, it sounds like it's going to be horrible. Risk managers need to be very watchful. It's potentially a time to look at trade credit insurance. If for any companies that don't have it, it's certainly a time to be very conscious of the terms and conditions for those risk managers who do have it. So with those final remarks, I think we'll leave it there. Just a reminder as we turn off, there'll be a survey. If our attendees today would be kind enough, please, to complete that before you go. I just want to say, be mindful of the EMIC mentoring scheme that's available. Mindful also that EMIC Fest registration is now open. So if you haven't registered, please do. And a final thanks to Andrew and Babak for a fascinating hour well spent. Thank you very much indeed, guys. Thanks to everybody. Have a good day. Thank you.
Thanks all.
Thank you.